We are seeing uncertainty around the world. In Asia, it's unclear how North Korea will move forward now that Kim Jong-il has died. In Europe, uncertainty remains as leaders try to find a solution to the debt crisis. And right here in the United States, there's political infighting about how to help out the American worker, how to pay for a payroll tax cut. What does all of this mean as you try to put together your strategy and put together these pieces to come back and invest in the new year? What should be your 2012 strategy? We're joined by BlackRock's head of global equities to try to figure that out. Rich Turnill joins us now. BlackRock, of course, is the largest money manager in the world with more than $3 trillion in assets. He joins us from London. Richard, welcome to the show. I have to say, given the uncertainty right now, how are you protecting your portfolio?
Yeah, I think there's a lot to worry about for 2012, and you can add the economic slowdown and declines in earnings expectations around the world to the list you just gave. And I think the way to protect portfolios right now is to first of all focus on geographic diversification. Secondly, to focus on quality, and by quality I mean quality of business model of the companies that you can invest in. And thirdly, is really to focus on balance sheet. I think balance sheet is going to be a very important issue for 2012.
And for you, that means avoiding the financials.
I think it means having limited exposure to financials. I think we can still find some financial stocks around the world which meet those criteria. But in general, I think many banks still are over-leveraged, still have significant risk of capital raise, particularly when we look at Europe, and are not well positioned for the economic environment that we're likely to be facing over the next 12 months.
You oversee $10 billion in large cap global equities. When you're talking about geographical diversification, what does that mean? What's your breakdown?
So today we continue to have significant exposure to the U.S. market. We find many attractive stocks we're investing in the U.S. Perhaps a surprise to you might be that we're really finding very significant opportunities within Europe. So a lot of people focus on the negative headlines around Europe, but don't fully appreciate the quality of some of the stocks listed in the European stock market. So we have considerable exposure within European markets today, but trying to avoid financials, avoid domestic exposure within Europe, and increasingly adding to our Asian exposure, both Asian ex-Japan, and then I think the real change over the last few months has been adding to Japan itself. So that's been an area which we've tended to avoid for many years. Due to high valuations relative to the rest of the world and less attractive shareholder focus. But both those things are starting to change. So incrementally adding a little bit more to Europe, high quality stocks, and adding a little bit more to Asia, including Japan.
What is high quality in Europe right now?
Yeah, I can find many high quality stocks within Europe. So we can start with the healthcare sector, where you've got some tremendous companies like Sanofi, Novartis, Roche, generating very strong international revenues, benefiting from the weakness of the euro, the weakness of the Swiss franc. Again, very strong balance sheets. I can look at some of the telecom companies like Vodafone. Again, great international companies paying high dividends and growing those earnings and dividends over time. And even when I look at some sectors which traditionally are not considered so defensive, so some of the consumer stocks, I think of a stock like Swatch, some of the luxury goods companies, very strong balance sheets, continuing to grow their earnings in a very tough environment. And the reason they're able to do that is that they have significant global exposure. So these are European listed companies, but they give you great global exposure.
Now, you have telecom stocks as a fairly large weighting within one of your portfolios. What could change? Here in the United States, we've been looking about that debate about consolidation within telecom. Are you going to shift your allocation in this new year?
So we continue to like the telecom sector. We're seeing companies there which are paying very attractive yields and are growing those dividends over time. And one of the things that is changing is that pricing power for the first time is starting to return. So here's a sector which has really lacked pricing power for the last decade. And that's one of the reasons the companies look so attractively valued, that they're effectively priced for ongoing deflation. But with the advent of the smartphone, increasing demand for data means that you're starting to see the first signs of pricing returning. So I think some attractive fundamentals driving the sector. I think it's important to be very stock specific, though. We saw with Telefonica only a couple of weeks ago that even internationally diversified companies like Telefonica are exposed to what's going on in peripheral Europe. So I think it's very important, again, to focus on the fundamentals of the businesses and focus on quality within the telecom sector.
Richard, thank you very much for giving us your 2012 portfolio. Appreciate your time.
My pleasure.